All right, you're welcome to our class. We've taken already 25 minutes of the class, so we're likely to go to 9 o'clock today. But nonetheless, I would always want to start with an introduction to tell you that I understand that you may have read group account and you have your own way of getting it done from the previous diet. But I just want us to go through a different route today. Just behave as though you don't have an understanding of group account and just follow through with the class. Now, the reason I would say that is in group account, they are basically concepts that you need to understand. If you understand the concept properly, you will be able to, let me turn off the mic. You'll be able to do well in group accounts. You need to understand the group structure. You need to understand what a subsidiary is. You need to understand where you need to consolidate. You need to understand what group intercompany transactions are and when it is important for you to eliminate them. Where are you supposed to deduct excess profits and just that. So I'm going to show you the pattern through which you would remember how all of this is done as we progress in our class. So what's its group accounts? From the definition, is basically combining more than one subsidiary account. A parent has several subsidiaries and wants to combine the accounts. You always hear of group of companies. How do they present their account? How do they put all of the subsidiaries together? So a parent basically is any company that owns more than 50% of another company. So if company A owns 51% of company B, then company A is the parent of company B. It's simple. So Dangote owns 51% of UBA. So it means UBA is a subsidiary of Dangote, and Dangote is the parent of UBA. Do you understand? Can you see my screen? Can you see my screen now? You can drop on the comments. Can you see the screen? All right, good. So we said that a consolidated account is a financial statement that combines the financial information of a parent. So I tried to explain what a parent is. A parent is any company that owns more than 50% of another company. So if company A owns 51% of company B, company A is a parent to company B. That's how it is. Now there are thresholds. So we could have an investment in a company. It doesn't make you a parent of that company. The percentage share holding you have would go a long way to determine if we should look at it as a parent-subsidiary relationship or as just a normal investment in that company. So that is why the percentage is important. You need to remember that. We are saying that parent, this is the main company that owns or control one or more subsidiary. This is the entity that prepares the consolidated financial statement and owns at least 51% of the other company. I don't know if that is clear. Then subsidiaries, these are companies that are controlled by the parent company, usually through owning more than 50% of the voting shares. Subsidiaries are included in the consolidated statement. So what we basically want to do here is somebody saying, I can't see you, I can see. I don't know if it's applicable to everyone. So we say, what is the consolidation process? To put it as in a layman's way of thinking is just to take the subsidiaries account that the subsidiary has prepared and add it to the parent account using the percentage of holding. So if I own 51% of whatever you do in your company, I cannot add 100% into my books. I have to add what I own in your company, and that's what consolidation is about. So basically, we said that a parent owns 51% or more of a subsidiary. If you have 20% below, it's just an investment. But when you have up to 51%, then you are the parent of that company. When it is a 50-50, it's more like a partnership. So that's an equal shareholding. So both companies would have to come together to make any decisions. Yeah, it's still saying something theoretical. Say consolidation process. The financial statement of the parent company and its subsidiaries are combined. Elimination of intercompany transactions, very, very important. As we progress in our class, we'll say you identify any intercompany transactions. Let's say the subsidiary is selling to the parent, or the parent is buying from the subsidiary. You would need to identify that transaction and eliminate it in full. That is what we'll be doing in this class. We'll be looking at the transactions. Oh, these are intercompany transactions. They are the same companies. They cannot be selling to each other. That's what the standard said. So you have to identify it, eliminate it. They are the same company. They cannot give loan to one another. You have to identify it, eliminate it. That is what we'll be looking at. Like I said from the previous class, these are just normal things. It is about understanding the principles behind this. So you look at anything that has to do with intercompany, the parent sold, the subsidiary sold. So the bulk of our class would be, how do you identify when the parent sold? It's just from the English. It's just from the framing of the question. How do you identify when the subsidiary is selling? How do you identify when the parent is selling? What do you need to do when a parent sold? What do you need to do when a subsidiary sold? What do you need to do when there is a loan? Those are what we will be doing in the class. We said you have to consider the balance sheet, consider the income statement, the cash flow. Those are the possible things that you could do. So we have IFRS 10 and business combination, which which properly addresses what we'll be doing in this class. But I will not dwell more on the standard. I will just go to talk about non-controlling interest. They say when a parent company does not own 100% of a subsidiary, the portion of the subsidiary not owned by the parent is called non-controlling interest. When you hear in the journey of our class, you hear us say NCI means non-controlling interest. And when we talk about NCI, we are referring to the subsidiary. The subsidiary has a percentage share holding of that company. So let's say 20%, let's say 30%. That 20% is referred to as the NCI. That 20% is referred to as the non-controlling interest. I'll open the class for 5 minutes because I don't just enjoy talking to myself. I want to be sure that we are following. So we are going to be called that you raise your hand if you have a question. I'll call you, then you'd make your maybe a question. I don't want to keep talking and then we'll come back towards the end of the class for questions. For now, what have I said that is not clear to you? You can ask the question. So let me turn on the mic. I'll go to the queue. So Oji, you're raising your hand. You could go ahead to ask questions. Oji, you wanted to ask a question? If there is no question, then somebody should just summarize what I've discussed and what you understand. I want somebody to speak. I don't want to just assume you understand when you may not understand the key concept of what I've said. Does someone want to speak? You can raise your hand, then I'll call you. Yeah, Gbenga, go ahead, please.
Thank you very much, sir. From what you have actually explained, you said consolidated financial statement is just talking about the financial statement that is marked together both the one that is for parent and the one that is for subsidiary. And how are we going to know those the person that is parent is if the company owes more than at least 51% of the shares or the ownership of that of the other company, then is the parent, while the other one is the subsidiary. And you said the remaining percentage that was left is for what we call non-controlling interest, if I can get you very right. Yes, sir.
Yes, you're right. All right, thank you, Benga. So, Victory, you wanted to add to what, or you have a question?
Sorry, good evening, sir. I didn't
Good
join
evening.
the class on time, so I don't really know what the topic is all about. So I was wondering if you can start all over.
Well, technically, I wouldn't start all over, but I will just quickly run through what I have said and go to the next information. So let me allow Moses to speak, then I'll continue the class.
All right,
So,
thank
Vicky,
you.
don't worry, I'll carry everyone along.
All right, sir.
Thank you. Good evening, sir.
Yeah, Moses, go ahead, please.
In a situation whereby we have like two subsidiaries, so is it compulsory that a parent company must have at least 50%? Because if we have like two subsidiaries now and they contain 60% of the company and the other one has 40%, like the subsidiary have 35, 35. Okay, 30, 30.
Okay, I would answer the question.
Can we call it parent?
All right, so I'm closing the class now. Now, just to quickly add, I wanted us to have a conversation, not just me presenting. Just as Moses has asked, it is not possible to look at it that way, but it is possible to have two subsidiaries. One parent can have two subsidiaries, but it would mean that the parent has 51% at least in each of the company. So let's say I have 40%, it means I'm not the parent. If I have 50%, I'm not the parent, because it means those other two companies put together would equal to my own shareholding. It means I'm not the parent company. I'm only having an investment. I'm only investing in that company. I'm only a shareholder in that company, not the parent. The idea is about decision making. It means you can single-handedly make decision without the non-controlling interest interfering. That's what it means. You can tell them what you want, what decision, what strategic focus, what strategic goal you want for the company. That's why you need to have 51% shares before you can be a parent. Now, I'll go back to the first example that we have there. In example one, we are simply saying that imagine company A owns 80% of company B. So what will be the group structure? The group structure is that the parent has 80%, the subsidiary has 20%. That's what it means. So if company A wants to show its financial position, it combines its own financial information with 80% of company B's financial information. That's basically what it is about. Now, I always say that in consolidation, you have what we call the big five. What is the big five? Let me type. I always say the core things you must understand is the big five. The first thing, we're talking about the big five. So, no, I'm not talking about the big four, I'm talking about the big five. The first thing you must understand, which you must be familiar with, which you will take your time to study, is the group structure. The group structure is referring to the percentage holding. Like in this case that we have up there, we have 80-20. That's a group structure. Then the next thing you have to understand is the NCI, the non-controlling interest. We'll talk about the retained earnings. Retained earnings. Talk about the goodwill. The group structure, the non-controlling interest, the retained earnings, the goodwill. It's important, the goodwill. Then the net assets. Now, let me put it in the other way. Let me put net assets here. Net assets of the subsidiary. Then I'll put NCI here. non-controlling interest. So the first thing you need to understand when you see a group account question or when you are trying to consolidate an account is to understand the group structure. The group structure is very important. It's vital we look at what is the group structure. Looking at this question, for instance, the example we have, the group structure is simply 80-20. So let's do this. Let me share. Let me share my entire screen. So here we go. Can you see my screen? You can react, maybe a thumbs up if you can see the screen. Yeah, I want to see the reactions. You can see the screen. Okay, all right. So when we talk about the group structure, we are looking at how is the subsidiary divided? How is it divided? What's the division? In this case here, we're talking about company A. So we have company A. We have company B. So this is 80%. And this is 20%. Very important that we should have it. So this is a group structure. After you've understood the group structure, the next question that should come to your mind is what is the net asset of the subsidiary? After that, what's the retained earnings of the parent? This is retained earnings of the parent. Retained earning of the parent. And let's say retained earning of the subsidiaries. Let's just put it together, retained earnings. Now, what is the goodwill and what is non-controlling interest? From all of this, what is goodwill? Now, in my days trying to understand what goodwill is, I've always seen that it's a problem for most persons to understand what goodwill is. And so I try as much as possible to explain what goodwill is first before we start talking about it. So imagine that you have a shawarma stand and your friend wants to join your business because they think that your shawarma is good. Now, your friend decides to buy a part of your business to become a partner. But your friend doesn't just pay for the shawarma stand cost and other things that you use in making the shawarma. They also pay because they think your shawarma stand has something special. Maybe you have a lot of loyal customers, a great reputation, a prime spot where people love to stop by. The extra value your friend is willing to pay for the special things about your business, like your good reputation, brand, or customer loyalty, is called goodwill. So goodwill is really the extra value a subsidiary is worth. In the exam, if you define it the way I've defined it, it is correct. The extra value the subsidiary is worth is the goodwill. Now, what are we talking about when we talk about the goodwill? You would see that in trying to calculate the goodwill, you would need to have what we call the purchase consideration. What is purchase consideration? Purchase consideration is the amount that the parent offered or paid to acquire the numbers of shares in the subsidiary. If the parent paid 50 million and part of their own shares, they exchange shares because they can exchange the shares they have, or they can say they will pay some part in the future, which is called deferred consideration. All of those put together, if you value it and you take away the net asset of the subsidiary, whatever is left is the goodwill. Why is it so? It's simple. Understand this. Let's look at the accounting equation. The accounting equation says that your asset is equal to your liability plus owner's equity. So it means that if I want to get the net asset of any business, the net asset will be the same thing as the asset less the liabilities. So it means that the equity is equal to net assets. So if I look at the equity part of my balance sheet, all of those figures put together would be equal. The total equity should be equal to the net asset. It will be what the subsidiary is worth at the particular time. I'll say it again because this could be confusing. First, I will go back to where we started. We started from group account. We said consolidated statement. That's what we are looking at, group account. Group account has to do with a parent combining the account of the subsidiaries and presenting it as one. The parent, for you to be a parent, for you to call a company a parent, the company must have 51% shares in the other company. If company A has 51% share in company B, company A is a parent of company B. Now, I have 60% shares of a company. I'm the parent of that company. The company has 40%. That 40% is known as non-controlling interest. Back to what I'm saying. So the group structure in that case would be me, 60%, the other company, 40%. We are now saying that what is goodwill? Goodwill is the extra value you pay above the net asset, above the value of the company, because the value of the company is simply the owner's equity, it's simply the net asset. So when you take all your assets you have, it's like, what is the value of you as a person? I have 50 million, I'm owing somebody 20 million. So how much do I have? Technically, I have 30 million. That's what it is. So if somebody wants to now buy you, and let's say you are worth 50 million, but you're owing somebody 20 million, and the person's paid 50 million, it won't be a true reflection of what you are worth. The extra 20 million the person has paid is the goodwill. It is because you are a good person, you have a good name. All of those things put together is what we refer to as a goodwill. The extra value as outside what the subsidiary is worth is the goodwill. That could be because of the loyalty of the customers the subsidiary has, or whatever the case might be. That is what goodwill is. Now, retained earnings, we know what retained earning is, but we will still talk about it better. Non-controlling interest, I have defined it. So I said the first thing to identify is the group structure. Sometimes in the question, you'll be given the group structure. They will tell you 80%, 20%. Sometimes they will give you the total value of the shares and how much the parent paid. So you can now calculate the percentage yourself. Most times they would always give you all the scenarios for you to calculate. But the first thing that will come to your mind is to get the group structure. If you don't get the group structure correctly, you might not be able to solve the questions correctly, because most of the things you will need the percentage to do the computation. But don't worry, it's a very, very simple thing to do. It's very simple to get the group structure. For some of the questions, yes, you'll get the group structure. Some you won't. But regardless, it is not a difficult thing to get the group structure. I hope what I have explained is clear. I've talked about all of these. In your notes, you would see the process. So if I want to calculate goodwill, I need the purchase consideration. Then I'll reduce the net asset of the subsidiary. Whatever is left is the goodwill. In some questions, you'll be given what they call impairment, goodwill impairment. They will say that, oh, the goodwill have impaired by this amount. So all you need to do is to take the value out of it and you would have your goodwill. I'm opening the charts for one or two interactions. You can raise your hand if you have anything to say or you have a question to ask from what I have said, before we now take a proper example. And in the examples, I would explain more. I would start from Mohammed. Mohammed, you want to say something? You can go ahead, please.
Thank you very much, sir. Good evening. Please, I would like to know the difference between what is it called? The goodwill, and can we call goodwill an asset? Can we refer to it as an asset?
Yes, it's an asset. If you are very intelligent and you have very good communication skill, is it an asset to you? I'm asking Mohammed.
Yes.
If you have very good communication skills, you have good negotiation skills, is it an asset?
Yes, it is. It is.
But if I want to value you, I might not be able to value your communication skills. I will just check the money you have, the land you have. I'll check all the properties that I can touch, I can feel. All of that. Then I'll take all your liability, all your bad character, I'll take it away. By the time I put your good thing, put it together, I will now have a value and say, okay, you have valued this amount. Those things I cannot value, which I know is still useful, is your goodwill. Your communication skill is your goodwill. So if you're applying for a job, for instance, you say, oh, I'm an accountant with 5 years experience. I can prepare this, I can do this, I can do that. But away from this, I know how to negotiate. I know how to support business partnering. All of those extra that you are worth, maybe because of your good names. Oh, yes, I know people. So if FIRS is to come for audit, I know people that I can call that will make life easier for us. That's your goodwill. Extra. Those things you cannot really, they are intangible, but they are useful. I don't know if I answered the question.
Yes, thank you, sir.
All right. So somebody say can you hear me? I don't know if it's for everyone. I doubt. We'll just go on. So let Mary, I think Oguntola, let her speak. You can ask either a question or you want to say something. You can go ahead. Mary, we're waiting for you.
Thank you, sir. I have question to ask. I was trying to signify
Okay.
that I don't see by your. I was not seeing your screen there.
But you can see the screen now.
Yes, I can see fine. Thank you.
Okay, thank you. Farouk, you can go ahead if you have something to say, or you've lowered your hand already. Farouk has lowered his hand. All right, so we'll continue with an example. Now, we have a question. You can check.
Sorry, sir. Please, I have something to say, sir.
Go ahead,
I
please.
also want to question to that. Yeah, sir.
So,
Please, there. Is somebody want to say something?
No, go ahead. Just when you
Okay.
finish, the next person can speak. Don't worry, go
Yes.
ahead.
One of the challenges I have with this consolidation
retain earnings.
accounting is.
I'm not really clear about the retain earnings. Maybe
No,
it was
please,
due to
let's
the
just be,
network.
because
Please,
of the
can you share
recording
more
and
light
other
on that?
persons that will join us, please just do one at a time. Let this person finish talking, please. Thank you. Go ahead.
Okay. So one of the major challenges I have with this consolidation account is, like at present now, we are just dealing with consolidation of financial position. But when it is combined with the statement of income, the interbank transaction, like goods sold, the treatment of goods sold between, especially between the subsidiary and the parent company, the treatment, how do you make the adjustment between the statement of financial position and statement of profit and loss? Then that's one. Also, when it is interbank loans, as well as that one. Also, when the parent company use a share to acquire the subsidiaries, the treatment. I don't know if it is too early to ask this question, if it is the right time to ask, and the treatment of all these. Hello, sir. Hello. 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 Hello.
We can hear you. I think he has been logged out.
I think he's having a network issue.
Okay, I don't know if I should recap or he got what I said.
When he comes back now, just
Hold
hold
on,
on.
hold on until he comes back.
Okay.
Please recap.
Okay. Yeah, my question was like the treatment of interbank transfer, especially loans and sales of inventory, when it involves statement of financial position and statement of profit and loss. So the treatment of it when it is a subsidiary that sold a goods or inventory to the parent company. That's the one question. The other question is,
Okay. Thank you for the question. If other people wants to want more good for them. But I think it's Lilia. Do not worry about what you used to know. I don't know. Can you hear me? Can you hear me? All right, no problem. So I'm sure you will listen to the recording afterwards. So it's fine. So just to maybe for that person, all right. Forgive me that I had to turn off the mic. What you are asking is a little bit early. We are yourself with things that you are not okay. You do not understand anything. And one of the reasons why most times accounting, because you guys have knowledge of what you are learning now. So sometimes, so I would go ahead, move in this class, but it's not on our side. You can check it on your own. This is the May Diet, 2015, May Diet, 2015. Now, I want us to read this question as though we understand what we are reading. Usually, because the icon question is always a very long one. Can you see my screen? You can indicate if you can see it. Let me stop and share again for some persons that won't see it. So I'm sharing only the question. So I want us to take some time and look at it. Now, the question is question number 1, May 2015. I'll just say U for this unitarization. U is a successful Nigerian company which recently amended its object clause in the MA to include this. The company therefore acquires 60% of the equity shares. So from this question, if we were to get the group structure, we would have we say we have 20%, we have 60% and 40% of the subsidiary. That's what the group structure would be. If you have to look at the question, 60 and then 40. So the parent has 60%, the subsidiary has 20%. The summarized draft financial statement of the two companies are as follows. We have the financial draft. Well, my system is a little bit slow. I don't know what's happening. It's the network or something. So we can see I'm going down to the adjustments. You can check. This is the May Diet. You can open from your end. So if my screen is not that visible, you'll be able to see from your end. So I'm going down to the requirement. Each line in a consolidation statement is important. Now, relevant additional information are presented below. The shares of Famous PLC was acquired on the 1st May 24. It's important to know the date of acquisition. The date of acquisition in this question is 1st May 2014. So the date of acquisition is an important date. We need to know that when computing. So from this question, like I said, it is May. They said the shares of Famous PLC was acquired on 1st May 20. So this is the date of 1st May 2014 is the date of acquisition. There's a cash in transit of this amount due from this. The non-controlling interests are valued at full fair value. The fair value of the non-controlling interest at the date of acquisition is this. There is no goodwill impairment. The fair value of Famous borrower, the 60% shares was settled, was settled through share exchange of 2 shares in U for 3 shares in Famous. The market value of U at the date of acquisition was 6 per share. In the post-acquisition period, all of these grammars. Now, what they're now asking you to do is to prepare the consolidated profit or loss and the consolidated financial position and changes in equity. Then they ask a theoretical question. Now, my concern here would not be to do any of what they've asked. I want us to do, we are going to focus on how do you compute the goodwill. Before you can talk about the preparation of the financial position, you must be able to calculate the goodwill. Now, for you to calculate the goodwill, you must understand how to compute the net asset list of the subsidiary. In the net asset list, there will have to be a way of doing it. So I'm going to show you a sample. What I need you to do is that if you have the question before, you try and open it to help. So I'm sharing my screen so we can attempt that question. I want us to see the focus of today's class is how do you calculate goodwill? So first of all, the first item on our list is the group structure. We say number one, we need to understand the group structure. And in this case, we have you, which is, and famous. Then we have famous. So you can use F for famous. So we have 60%. In your exam, you can do it this way. In your first page, you can have 60%, then 40%. Then in between, you can say your date of accusation. DOA is your date of accusation. In the question, we say that the date of accusation is, in that part of the question, there's a part that says the date of accusation. We say it is 1st May 24. 1st of May 24. Is it 24 or 20x? Whatever the case, let's just say it's 2014. So this will be 2014. Now, another thing you need to consider is your reporting date. What's your reporting date? Some people call it your consolidation date. Your date of consolidation is important also. I'll explain why the account is being reported. So they say statement of financial position as at 31st October 2014. 31st October 14. No, now we need to know the difference between the date of acquisition and the reporting date, or the date of consolidation. How many months is between May and October? In our comment section, how many months is between May and October? The question is May diet 2015, I think. That's the question. May diet 2015, number one question. So what we need to do now, we have to look at, since the date is starting from the first day of May, you have to count May, June, July, August, September, October. So 6 months is the correct answer. So we have 6 months in between. Now, I have gotten the group structure. It's important to always remind yourself this group structure. Put it this way, I've done it. Put the date of acquisition, date of consolidation to know that this is 6 months. Now, I'll go to the next important thing in our question. Number 2, I said you need to be able to, in the big 5, I mentioned that we should have net asset list. Group structure number 1, now is net asset list of the subsidiary. So I'm going to have net asset list of the subsidiary. In this, I would have the date of acquisition, because this will be in your workings, you can abbreviate. I call it reporting date. I prefer reporting date, or you can call it date of consolidation, or consolidation date. Then we have post acquisition. So we have the items. So from the question that we have, we said that, let me share my entire screen. I hope you're following. You can comment if you're not, if you're lost at any point, you can let me know. So from the question we have, I'm going to the beginning of the question. We've been able to look at the group structure 60-40. That is clear to everyone, I assume. Then I said we should calculate from the big four, the big five I talked about. I said you have to look at the group structure, which in this case is 60%, 60%, and 40%. You have to be able to state it. If you look at your marking scheme, the group structure is also important. Then you have to know your date of acquisition. That I don't know if that is too much of an English. Date of acquisition is the date that the shares were bought. Like in this question, look at it here. They mention it. They would always mention it in the questions. They say the shares of Famous. Famous is a subsidiary in this case, right? Was acquired on 1st May 2014. So this is the date of acquisition. The date you have on the account is your reporting date, or your date of consolidation is the date you want to prepare the group account. That's what it means. Now, you need to understand these parts. It will take you some time. It might not be this class. It may be this class. The first thing you need to understand is, how do I get the net asset list of the subsidiary? If you go to the question, in this statement of financial position, the net assets, like I said earlier, it's the same thing as the equity part. And this is the equity part. This part I've highlighted is the equity part. So you need to pick out this part for the subsidiary and the additional information. So the first thing we should take now is the equity shares, or you call it the shares capital. But let's just take it as equity shares. So I'm going to I'm turning on the mic. You can raise your hand if you have any concern so far. I want to progress in the net asset list. We've been able to look at the group structure. You can just download the question. It's available online, right? The question is May 2015 Pathfinder for financial reporting. So the question is saying, this company, 60% equity shares. So I'm saying the group structure is what we have done here. The group structure is this, is simply U for utilization, famous 60%, 40%. Date of acquisition is 1st 5/2014. Reporting date or the date of consolidation is 31st 10/6. In between this thing, we have 6 days. We have 6 months. It is important to know because when we are adjusting, we might need that 6 months. That is why I want you to know the difference between the reporting date and the date of acquisition. If it is up to a year, then you don't have problem. You just do the mathematics regularly. But if it is not up, there will be need for proration. So there's a need for you to know how many months you are going to prorate your computation. That is why it is needed. So you have a question. Let me see. Group account is always complicated. It will take time. It will not be that fast. For some of us, you may already have understood this, but a whole lot of us, it will be new for us. So, Juliana, you can go ahead if you have a question or you have something you want to ask. Okay, to answer Sophia's, you need the net asset in your computation. Now, I would explain the essence as we progress. I might not be able to explain the essence fully now, but now understand what you need. You need to calculate the net asset list. So what we should be worried about right now is how do you calculate it? When we finish calculating it, we'll now know why you need to calculate it. But if I start explaining that, it's going to be confusing to a whole lot of us. Juliana, you want to say something or you are fine? The comments, if you are good, tell me you're okay. Let me continue. Are we good? Are we good? I want to see the comment that we are fine so I can continue. Oh, you're confused. Hello, hello. It shouldn't be confusing. It's a straightforward thing so far. Nothing confusing. Well, there is no particular name for the period. It's just the difference between the date of acquisition and the date of consolidation. It's important because when you are trying to prorate, you will need it. That's what it is. You don't need to call it by any name. All right, so back to what we are saying. So the equity. Remember that what we are calculating is the net asset list of the subsidiary. Most persons get confused. Look at this question. You see under U and under F, you have equity. You have retained earnings. When we are talking about the net asset of the subsidiary, this is the part we're talking about. We're not talking about this other part. So I'm going to take this 2,4. This is already a million. So you can do the same here. This is also a million. This is also a million. Another thing you should be considerate of, in the additional statement, they would put the figures in full. And in your workings, you have abbreviated it. You've taken it in millions. So when you are bringing from your additional information, do not bring it in full. If you don't understand what I've said, now ask questions. But I'm going on. So you have 2,4. You would have 2,400. 2,400. Your post will be 0 because your post is supposed to be the difference between your reporting date and date of acquisition. C minus B. C minus B. That's what it should be. C minus B.
Sir, which equity are we actually bringing now, sir? Which of the equity?
Subsidiary.
All right, I would answer the question. Like I said just now, if you were following, you would have gotten what I said. Look at this part. Look at the title. It's important. I always prefer you to understand things. Look at the title here. We are looking at the net asset list of the subsidiary. if we're looking at the net asset list of the subsidiary, it would be wrong to take this equity. So definitely we are taking the equity under famous, which is the net asset list. We are working on the net asset list. So what you're trying to compute now is the net asset list of the subsidiary. So we are taking the equity of the subsidiary, which is the 2,400, 2,400 equity. The next thing we can look at there is the retained earnings. Remember, we are looking at the retained earnings of the subsidiary, retained earnings. What we have here is saying 39. This is reporting date retained earning. It is not the retained earning as at the date of acquisition. What we need to do is to look through the questions if they would give you retained earnings at the date of acquisition. If they don't give you, then you have to compute it. So let's go through the questions again. Here, they didn't say anything. Under the additional information, the shares of Famous was acquired, yes. There is a cash in transit. The non-controlling interest is valued here. Famous value were equal to the current amount, except this. The 60% shares of Famous acquired was settled through share exchange of this. In the post-acquisition period, so there's nothing Famous trade, there's nothing that says, that mention the retained earning as at the date of acquisition, but it is simple for us to get. Remember that here, this is Famous books. This is the profit for the year. Profit for the year, remember, it's not profit for 6 months. And this account we are working on is only for 6 months. So what it would mean is that there is a 6 month included in this profit. Six months. So we have 6 months before and 6 months post. The profit for the year. 6 months is post acquisition and 6 months is pre. So what we need to do now is to compute. How do we calculate that? You say that the profit for the year. Profit for the year is what? Is 1,800. So it means that there is a 6 months which happened after unitarization has bought Famous. That is referred to as the, so you can say equal to 6 out of 12 times 1/8. This is 900. Now this 900 is the post, is the profit that was gotten after the parent has bought the subsidiary. So what we'll do now is, in this our net asset list solving, in post, we would have 900. Look at the one in post would have 900. And then in our reporting date, we already have a figure. The figure for reporting date is 3,900. So which means the date of acquisition will now be equal to this minus this. So it's this amount, 3,000. I'll pause. I'll take the mic so you could talk, because I know it might be confusing. It's usually confusing. Oh, God. All right. Like I said before, I don't know if most of you did not join the class from the beginning. I am not going to discuss everything at a stretch. Just follow what I'm doing. It's not a theoretical class where I will just come and say method of calculating goodwill. I'm not even calculating goodwill. Somebody's already asking me about goodwill. What we are calculating is net asset list. We are not calculating goodwill yet. So I can't be talking about the method of calculating goodwill when we've not started goodwill. Just follow through. I know some of you already have read ahead of time. I know some of you know these things before, but follow through the way I'm going about it. Understand a bit of what I'm doing before we talk about the future. Right now, what I said we are doing is net asset list of the subsidiary. So here I've calculated retained earnings. If you have questions relating to how we got equity, how we got retained earnings, you can ask me before I progress in the class.
So what if it was just profit, not profit for the year? Are you going to assume that's profit for the year?
Retained earnings and profit for the year is usually the same. So yes, it's fine, whatever they call it, but it's not profit before tax, so long as it's profit.
Okay.
If it is not mentioned, now in some questions, they will tell you what the retained earning is at the date of acquisition. If they don't tell you, this is how you compute it. If they tell you, you don't need to compute anything. Look at the question again. Some persons are asking me how I got 39. This is 39. This 39, this is the date here. Statement of financial position as at 31st October. So the reporting date or the date in which this account has been prepared, in which we want to consolidate, in which we want to now put U and F account together is 31st of October. So that's why I put under reporting date, there's 39. But what we need to calculate, we needed to get the date of acquisition. The date of acquisition might be given to us in the question, but if it's not given to us in the question and we're giving our P&L, in the P&L, take the profit of the subsidiary. Admin is a full year, it's not a 6 month. It should have been different, but because in this profit is for 1 year. We are now saying that 6 months of this profit must have been made after you bought F. How do I know that? You bought F in May 2014. As at October 2014, they are saying that the profit for the year is this amount. Profit for the year is not 6 months. So it means 6 months of it is after. That's what they call post-acquisition. It is after they have bought the company that profit was made. So that's what we need to take. I don't know if it is clear. This is important. If you understand this bit, you would be able to follow along. And that's why I'm taking my time. Some people will say, oh, no, the time you are taking too much. Let's go. Go ahead, please. You're already talking.
Okay. My question is that 900 that we deducted from the retained earning, is it the post acquisition or the before the acquisition date?
Is the post acquisition. Let me explain this thing to you again. Look at the question. Open mind, please. Forget about that this is FR. Let's look at it together.
Hello, please,
Normal
I cannot
mind.
see your screen.
I think it's a
I
network
cannot see your
problem.
screen. Can you hear me, please?
Yes, of course, I can hear you, but I do not think everybody cannot see my screen. Maybe it's just you that can't see the screen. All right, so I want to explain something. Now, look at this. They said that the shares of Famous is a subsidiary, remember, was acquired these dates, 1st May 2014. Before Unitarization PLC bought Famous has been in business. Famous has a profit for 1 year. But you has not bought this company up to 1 year. It's only 6 months that you bought this company. From these 6 months, 6 months of this is before you bought Famous. 6 months is after. That's what they call post acquisition. Acquisition is when you buy something. After the acquisition, there's a 6 months. So I'm going to just assume there's something in the question too. Look at this question. The question said that assume that profit or losses accrue evenly over the period except otherwise stated. What this statement is telling you is that you can assume that the 6 month, each month is the same profit so that it doesn't lead to complications of calculation. That's what the thing is saying. What I expect you to do is maybe you find a way to get this past question, you download it so you don't have to worry much about the question. It will be more of the solutions because you are saying share your screen, share your screen, share your screen. It's leading to a whole lot of back and forth. So just ensure you have the pathfinders. So when I mention anyone, you can check it from your book and then you follow through. But if you don't have the question, it will be difficult for us to solve through. So back to what I was saying. So this profit is for 1 year. This profit is for 1 year. 6 months of this profit is made after you had bought F. That's what I'm trying to say. So on this table, you put that 900, which is 6 out of 12 times the amount, which is the 1/8, to get the post. Since you have the reporting date, by the time you take the 900 from it, you will have the amount in the written earning as at the date of acquisition. Now, in those days where we are in school, they usually say that sometimes the way the teacher explains, it's not clear enough. So I'm going to give the floor. Please let me call you before you speak so that it won't be rowdy because we are more than 100 here. So is there anyone that feels, oh, you understand what I've said so far, you want to explain in your words so that we can follow through? You can raise your hand if you understand what I've said so far, based on what I've been explaining, not because you know it very well before, based on what I've explained, you understood what I have said, and you want to explain to us, you can raise your hand. Let's be sincere. If you understand it based on what I've explained. Audrey, I want to assume you understand what I'm saying and you want to explain to us. If I'm right, you can go ahead and speak. Audrey is not there. Benga, do you want to explain what I've said?
All right, thank you very much. From what I can understand from my side here, you said the OL, where we are going to start, actually, we are going to start from the group structure, whereby we are going to know what is the percentage of the parent and what's the percentage of the subsidiary. And from the question we are examined, we are made to understand that unitarialization acquires 60% of famous asset. So meaning that yes, by the group structure, unitarization has 60% and famous has 40%. And you said that we should consider 2 dates, very, very important, which is the date of acquisition and the reporting date. And from the question that is being presented, we were made to understand that the date of acquisition was actually 1st of May 2014, and the reporting date was 31st of October 2014. So the difference between the 2 dates was discovered to be 6 months. And you said that that 6 months is what is going to be we are going to use as a proration for us to be able to apportion each allocation for each of them. And now we are out of the 5 big 5 that you say we should first of all consider anytime we want to do consolidation. We have done that of group structure. The next one we are looking at is net asset of the subsidiary. And you say how we can be able to get the net asset of the subsidiary is by going through to their statement of their financial position, where we are going to see what is the percentage, what's the actual asset for the subsidiary. And from what we've seen here, from the information presented, they have only 2 assets that we are actually considering now, which is equity shares and retained earnings. And equity shares at the reporting date was 2,400, and we don't have any information as per whether they actually have issue pertaining to the increment or decrease in the share capital equity share. So we believed the same money that is reported for the beginning is still the same that is reported at the end. So there is no any profit, there is no any addition, there is no any deduction. So because of that, we are having the date of acquisition to be the same thing as that of the date of reporting. So the post-acquisition, there will not be anything because there is nothing like increment or decrement in the equity shares of the subsidiary. So that is for number one. For the number two, which is the equity retained earning. Retained earning, we were not giving the opening balance. That's for date of acquisition, how much was actually earning, but we were giving for the reporting date, which is 3,900. But how we are able to know the post acquisition, we go to our statement of profit or loss account for the this thing, and we discover that the subsidiary actually make the profit of 1,800 naira as at 31st October 2014. So, and this 1,800 naira was the money for a whole year, which is 12 months. And now what we are actually considering now is for what is 6 months, based on from the date of acquisition to the reporting date. So we are going to have 6 divided by 12 months, then multiply by 1,800. So whatever the difference, which is 900, is going to be for what's it called, for post acquisition profit for retained earning. So by the time we now look at this post acquisition earning, if we deduct this reporting on consolidation, the amount in the consolidation minus the post acquisition, whatever things we have, whatever difference we have, is what we will now know, we will now use as as our amount for date of acquisition. I think I am right. Thank you.
Thank you very much, Benga. Benga has said it in the same words I've used earlier. And I want to continue so we can progress a little in the class. Now, group account is a little bit confusing. And that is why I didn't want us to make it more complicated. The group structure, the first thing to do, then the net asset list. If you're able to understand the net asset list, you would have understood how to compute 50% of group account, 50%. Because adding line by line is not a problem. But if you're able to solve the net asset list correctly, you have the correct net asset list, I can assure you, calculating the goodwill, calculating the NCI, the retained earnings, all of those things would go very fine. I don't know why somebody is telling me we have PSA. Good. So now back to what I was saying. After you have done the part of your equity, you have to go to the additional information and see if there are any changes. Are there changes to more fair value changes? So I'll just call it fair value adjustment. In the fair value adjustment, you have to look at the changes that may have occurred. So let's look at the first one. They say the shares of Famous was acquired this date. It has nothing to do. There is cash in transit. It has nothing to do with your net asset list. The non-controlling interest at full value, it has nothing to do with your assets. The fair value of Famous PLC were equal to their carrying amount. at the acquisition date, except for one equipment with a fair value of this amount. So they say there is a fair value of an equipment. So here I'll put equipment. In this fair value adjustment, what you have here will be equipment. Under equipment, we say that we have 1,200. That's straightforward. So we'll just put it there. But they gave us more information, which means we needed to calculate the more. There's over its carrying amount, which has a 5-year remaining life. Straight line depreciation is adopted. Famous PLC has not effected the adjustment in the record. Because they have not effected this adjustment, that's why we're adding it. Now we need to calculate the depreciation. They say the depreciation is a 5-year remaining life. Normally, I should have just said to get the depreciation, I would say equal to this divided by 5. Should have given me the adjustment. But recall that it is not up to 1 year. So calculating depreciation for 1 year would not give us the bits that we need. So we need to divide it. I need to multiply it by 6 out of 12 to get the actual value. So it will be 120 depreciation, which will be deducted from both sides. So it will be negative because it's depreciation. I'm supposed to be negative for both of them. So what I did is just to do the proration. That's why I said the 6 months is important. So you are taking, this is depreciation. So we'll go back to this question again. The next thing that would possibly come is your unrealized profit. If there is any sales between the parent and the subsidiary, you would have what we call the unrealized profit. The unrealized profit would be, if it is the subsidiary that is selling, you can adjust the unrealized profit from here. But if it is the parent that is selling, you would have to adjust the unrealized profit from the parent's retained earnings calculation. Remember that here on this net asset list, what we are computing is the net asset list of the subsidiary. And it is in the retained earnings we are supposed to take out the unrealized profit. Now, you could decide to take the unrealized profit now on this net asset list, or when you are calculating the retained earnings of the parent in the future, as you go on with your computation, you can now take it out. But I prefer to take it out from here. So we have unrealized profit. What is unrealized profit? Unrealized profit is the profit the intercompany is claiming from sale of any commodity to one another. So if the intercompany, if the parent is saying, I have made a profit, or I'm supposed to make a profit of this amount for the goods I sold to the parent, you have to take it out from here. If the parent is saying, I have an unrealized profit, I sold some goods, I'm supposed to get this profit, you would have to take it. Don't worry, all of the questions, I can see them on the comment. I would address them. So let's go now to talk about how do you know if there's an unrealized profit? You would see a sale. There will be a sale of goods from either the parent or the subsidiary or vice versa. So you check it. If there's going to be a margin or a markup on it, you can compute the unrealized profit from there. Now let's go and see. Famous trade receivables include these. However, the amount did not agree with corresponding balance in this. That's not. In the post-acquisition period, Unitarization PLC bought goods from Famous. So which means Famous sold, amounting to this. Famous had made a markup on cost of 40% on the transaction as at the year end. You had sold part of these goods worth this amount. So unrealized means the element that has not been sold. So if you are saying that in the post-acquisition, you bought goods from Famous of this amount, Famous had a made a markup on the cost of 40% on the transaction at the year end. You had sold part of this goods worth this amount. So what is the unrealized profit? It will be the difference between this amount and this amount, then the markup. So we're going to do the markup of that unrealized profit. So it's going to be equal to, I'm opening the bracket, 48, what's the value there? 4,800 less 3,120 times 100 over 140. The question is, how did I get 100? Because it is markup. If it is markup, you will take 100%, which is the full percent, then add the 40 to the 100 over 140. That's how I got that. So this is what the unrealized profit would be. But where are you taking the unrealized profit from? From the date, the reporting date. So you have this unrealized profits. Negative of that. Negative of 1,200 will be the unrealized profit. Is anybody confused at this point? If you are confused at this point, I would let you ask questions. I'll let you ask question. I'll make the mic work now. Or you could put all of your questions in the comment section. This is supposed to be 1, 2. Let me see. This is 3030. Okay. All right, so let's ask questions. Let me open the floor for us to speak. Please just I'll call you, then you ask the question, please. So that it doesn't get rowdy. All right. Question. Because I see that from this net asset, this is where we'll likely stop. Then you can go to your next class. So question, please. Let me see on the queue. Yeah, somebody said the unrealized profit is not clear. Olaide, you can speak. Are you the one asking that the unrealized profit is not clear? Hello, Olaide. Okay, Rachel, if you want to speak, you can speak. Olaide is not available. Oh, I didn't do something there. I didn't prorate it. Yeah, who wants to speak? Okay, yes, what's the 40? Is 40 over 140, which is the percentage. It's supposed to be 40 over 140. Not 100. Yeah, that's it. Who wants to speak? Who has a question? Okay, like I muted. Wow. Thought I on thing. All right, let's go.
Hello, sir.
Hello,
Yes,
hello,
go
sir.
ahead, please.
Yes, you muted us.
Oh, I didn't know.
Hello, sir. Can you hear me, sir?
No, let
Can
Can you hear me, sir?
Olai speak first, then other persons can
No one
speak.
is
Yeah, I
speaking.
can hear you,
Oh,
but
let
Hello.
oh
let
yes, sir.
speak. Olai, go ahead.
Sir, please, sir, I would like you to go through that unrealized profit again. How do we know that we are to calculate it under date of under the reporting date? How do we know? Then please, help to recap it again.
Okay, now let me explain. For depreciation and unrealized profit, we are trying to reduce it from your assets. Depreciation is an expense, so you are trying to reduce it from the assets. Remember, unrealized profit is the profit in your head that you must have added to your assets, which would not come. So it's added to more of your inventory. The profit is added to your retained earnings. So we are trying to remove it from your retained earnings. Remember that the retained earnings is here. So anything that has to do with profit, it should have been added to your retained earnings previously. So you are supposed to deduct it. Anything you are deducting, you're supposed to take it from the reporting date. And then that same thing will replicate in your post. So even if I don't put it in my post, if I say this minus this, because there is nothing here, there is zero here, there's zero here, it's going to give me this value. That's just how that comes about. But let me explain how we come about this 120. That's what you asked. If you look at the question here, when you look through the additional statement, if there is any fair value adjustment, it will come into your net asset list. But if there is no fair value adjustment, you don't need to do anything. So you read through the question, the shares, the cash in transit, non-controlling interests are valued at full fair value. The fair value of the non-controlling interest is this. How do I know that you are supposed to add this one? They said that Famous PLC has not effected the adjustment in the record. And we are talking about an asset. Remember that this is a net asset list. They are saying the net asset value has changed, but it is not affected in their books. The fair value of Famous were equal to their current amount at the acquisition date, except for one equipment with a fair value of 1.2 over a carrying amount, which has a 5-year remaining life. So you need to 5 years just to say 1.200 divided by 5. That's what it should have been. But because it's not up to 1 year, we have a 6 month between the date of acquisition and the reporting date. We now take times 6/12. Do you understand? That means 6 months of it. This depreciation now is 6 months of it. Then this is for markup. So markup is markup on what? On the remaining goods. Look at these goods here. Don't get confused. They sold total goods of 4,800 to Famous sold to you. But as at this time, what is left is not given to us. We are supposed to calculate the unrealized profit on what is left. If I sold 4.8 to you, 4.8 billion worth of goods to you, and you already have sold 3.1, what is left of the goods is what you are supposed to calculate your unrealized profit on. And they say there's a markup on the cost of 40. Markup is usually the percentage given times 100 plus 40. So I'm supposed to say 40 under 40 plus 100%. So that's why we have 40 over 140%. Yeah. So it is the 480 is the total amount of goods sold, less what they have already sold. Because we are trying to calculate the profit on the unrealized, on the one that they've not sold, unrealized profit. So that is why we compute it based on the difference. So here now you have your net assets at the date of acquisition, your net asset at the reporting date, and your post-acquisition adjustment. That's what you have now. So we've computed our net asset list this way. Is it clear? Is it clear, Olaide?
Thank you, sir.
Are you sure it's clear? You just want
Yes,
to let
sir.
me go.
Yeah, hello, sir.
Hello, sir. I have a question.
Hello, sir.
Okay, from the hands that I raised, let me just call one person. Sorry. We have Tolulokbe. Tolulokbe, you can speak.
Thank you very much, sir. Okay, not to take, I just want to clarify something, sir. So,
Go ahead, please.
looking at this table you prepared, this schedule you prepared, I'm seeing that
Yes.
this is to ascertain the net assets of the subsidiary. But
Exactly.
yes, there is something that's seeming quite confusing for me. It is when you
Okay.
added uh fair value adjustment, that's for the equipment, and then
Mm-hmm.
depreciation and then unrealized profit. I've been struggling to hear you like all through the class. I was sharp straining my ear because it's very low at my end. But I was sharp following as you're doing it. So based on, yeah, let me just say past knowledge. Yes. So what I know, I don't want to confuse me, is that is when you want to get the adjusted return earning of the subsidiary that you use depreciation and unrealized profit. So now adding it in the ascertainment of their net asset is, I don't know, it's kind of
Okay, now.
is that another pattern? Is that another way you can do it? And especially this fair value adjustment is confusing for me. Please help out the bench.
Okay,
Thank
thank you
you.
very much, Tolulokbe. I'll take the next question in case it is similar to what she's saying. So, is it is Roots? You can speak, Roots.
Okay, sir, my question is on retained earnings. I don't know if you could throw more light on it.
Okay, no problem. You can go back to look at that. The next person, is it Dosu? Dosu, you can speak. We only have very few minutes, 8 minutes left. Because
Hello,
of the
can you?
network issue, and yeah, Dosu, you can speak if you're there.
Okay. I noticed that the what's called this figure, this 4,800 unrealized this thing. You said
Yes.
Okay, they sold 3,120. 3,000
Yes, they sold it.
that's plus the markup. Yeah. So but then we want to
No, before you
ascertain.
talk about the markup will be on the element that is left.
Okay, and the figure there, that 3,120, that's they've sold it. So the 3,120 is
Yes.
the plus the profit. So to get what is left, we're supposed to minus the 4,800 from the actual cost. Yes, sir. So from my end, what I'm getting here is different from what you got over there, sir.
No, see, you are thinking into the question. The question never said anything about having the margin on it. The question only said, in the post-acquisition period, unitarization PLC bought goods from Famous PLC amounting to 4,800, right? Famous PLC had made a markup on cost of 40% on the transaction. It is a full stop, so that statement is standing on its own. As at the end, unitarization PLC has sold part of these goods worth 3,120. It didn't say had sold part of these goods worth 3,120 plus the markup of 40%. He didn't say anything like that. He only just gave you the figures. The reason he's giving you that markup figure, it is because he wants you to use the markup when you are calculating your unrealized. That's what that information is for. It has nothing to do with your 4,800 or your 3,120. So all you need to do is just say 4,800 minus 3,120, then mark it up. That's all. For your unrealized profit.
Okay, it's clear now.
All right, now
Thank
to
you.
answer Tolu, you see, like I mentioned before, I don't always like to make things complicated. I like to do things the simplest way. If you do not take out your depreciation and your unrealized profit from your net asset list, especially remember that you can only take unrealized profit from your net asset list if and only if the subsidiary is selling. If it is the parent that is selling, your unrealized profit will not be taken out, will not be deducted from your net asset list. It will be deducted when you are computing the retained earnings of the parent. Now, if you don't take the depreciation and unrealized profit when the subsidiary is selling from here, each time you are calculating the non-controlling interest, you bring it in. when you are calculating the retained earning of the parents, you bring it in. So it's going to be more, for me, I feel it will be more complicated doing it that way. But that is a way that is being done. I think I'm about the only person that removes depreciation and unrealized profit from the net asset list. Even in the ICANN Pathfinder, they don't take it from here. They have a way of removing it from the NCI and the retained earnings when computing it. So what you need to do now is to take the shares for the NCI, take the share for, but in this case, I will not need to do again when computing NCI, when computing retained earnings. I only just share the post by their percentages to them. That is why I do it this way. So for me, this is the easier way. But as you progress in the class, you will now see why I'm doing it this way. I will still be able to explain to you how your own way and this way is the same thing in the end. So it's not a problem. You could choose, just follow what I'm doing. Let's get to, that's why I said follow what I am doing. Let's get to the end. If you now feel what I'm doing is more difficult to what you are used to, you can go back to what you used to do. But try and follow it as though it's the first time you are working on this so that you don't get confused. I don't know if I've answered the question, Tolu.
No problem. I will just follow like you said. So it means I would have to learn this pattern as well. No problem, sir. Thank you.
All right. So just follow through what we are doing. When we come, I'm the one adding the negative 120. Whatever the answer is, you are supposed to take a minus sign from it. So the answer is not negative for all of these two. I'm the one adding a negative sign. So you are supposed to deduct depreciation and unrealized profit from this. So I understand that the answer is positive 1, but you have to take the negative of it. So thank you very much for your time. There is no homework to be done. There is nothing. Just read through what I have done. I would share the class notes and what I have solved on the platform. Just go through it. By our next class, we'll continue. Thank you for your time, and do have a wonderful evening.
Thank you, sir.
Thank you, sir. Good night.
Thank you, sir.
Sir,
Good night,
thank you,
sir.
All right. Yeah, take care.
Thank you,
Take
sir.
care.
Good night.